Okay, so we're diving into a collection of investing wisdom today,
Hmm.
right? Including Benjamin Graham's The Intelligent Investor. And it seems like you're really looking to like cut through all the noise and figure out how to build real, lasting wealth, which is exactly what we're going to unpack today.
Absolutely. And it's interesting. You're drawn to this kind of material, especially now. I mean, think about it. We're just bombarded with these get rich quick schemes, market hype. It's like it takes me back to like the dot-com bubble that Graham talks about. Remember all those stories about like Exodus Communications splitting their stock over and over again? People thought they were suddenly rich
Yeah.
just because they had more pieces of paper.
It's like everyone thought they were winning the lottery.
Exactly.
Yeah.
And I think that's where Graham's definition of investment is so important. He doesn't define it by, ticker symbols or stock prices. Like he says hold on, let me get it right. He says it's an operation which, upon thorough analysis, promises safety of principal and an adequate return. It's about owning a piece of a solid business, not just, gambling on these short-term fluctuations.
Right. And speaking of gambling, I mean, some of the stats in these sources about market crashes are, well, they're pretty sobering.
Yeah.
Like, apparently, to recover a 95% loss, you need, get this, a 9,900% gain.
Wow. Yeah.
Those are some long odds.
It really highlights that psychological bias. Loss aversion. We feel the pain of a loss so much more strongly than we enjoy a gain of the same amount. It's just human nature, I think. And that's why, Graham, he emphasizes avoiding speculation and focusing on the intrinsic value of a business. But what's interesting is, even seasoned pros, they fall prey to market hype. I mean, look at the Fidelity Magellan Fund in the 90s. They were preaching this long-term thinking, right? But then they got swept up in that whole tech frenzy and ended up dumping billions into tech stocks within like weeks.
Wow. It's like no matter how much you know,
It gets you.
it can still get you.
Yeah.
That's kind of scary. That's
Yeah.
probably why Graham came up with that analogy of Mr. Market. Could you explain that a little bit more, for our listener?
Sure. So imagine Mr. Market as this, well, he's kind of a manic depressive fellow who just shows up at your door every single day, and he's offering to buy or sell stocks, right? But at these wildly fluctuating prices. So some days he's totally euphoric, other days he's just like utterly despondent. But the important thing is his offers, they're rarely based on any kind of rational analysis.
So it's all about his mood.
Exactly.
So how does understanding this, this eccentric Mr. Market, how does that help us become better investors?
Well, you have to recognize that the market's daily swings, they're often driven by emotion, not logic. It's like a roller coaster.
Yeah.
The key is to not get on that roller coaster with Mr. Market. Focus on the intrinsic value of the businesses you own. If you've done your homework, right, and you trust your analysis, you can actually capitalize on his irrationality.
So it's almost like you can use it to your advantage.
Exactly. You're using his weaknesses against him.
I like that. I like that a lot. So you mentioned doing your homework. How do these sources, how do they suggest that we approach building a resilient portfolio? Where do we even start?
Well, Graham stresses this idea of a margin of safety.
Okay.
It means you're buying stocks for less than they're actually worth. It's like a built-in buffer for those unexpected events,
Like a safety net.
Exactly. And don't underestimate diversification, especially bonds.
See, bonds, I have to admit, I've always found them a bit mysterious.
Oh, yeah.
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 What are they? Why do they matter?
Okay. So imagine loaning money to a company or even the government.
Okay.
In return, they're going to promise to make these regular interest payments to you and then give you your principal back at a specific date.
Okay.
So that's essentially what a bond is.
Okay.
They provide this steady income stream and they act as a stabilizing force when the stock market, it gets a little turbulent.
So it's like having that reliable tenant who
Right.
always pays their rent on time, even when everything else is,
Oh, even when the economy's crazy.
Exactly.
Graham suggests a starting point of 25% of your portfolio should be in bonds. And yeah, they might seem kind of boring when stocks are soaring, but they can really prevent you from making, those rash decisions when everyone else is panicking.
So it's about having that financial shock absorber.
Exactly, to smooth out the bumps in the road.
Okay, that makes sense. So we've got that margin of safety. We've got diversification with bonds. What else can we do to build that kind of unshakable portfolio?
One strategy that I think really fits with Graham's whole philosophy is dollar cost averaging.
Okay.
So instead of trying to time the market, you invest a fixed amount of money at regular intervals, and you do this regardless of what the market's doing.
So if the market dips, you're buying more units at a lower price, and when it rises, you're you're locking in some profits.
Exactly.
It's a very disciplined approach.
It takes the emotion out of it.
I like it.
Which is what you want.
Yeah.
Speaking of emotion, that's where things get really, really interesting. These materials are just full of these wild stock market stories, Inktomi's meteoric rise and fall.
Oh, yeah.
That just shows how easily we can get caught up in the hype.
Yeah. It's like those cautionary tales they should teach in school. Don't believe everything you read in the headlines.
Exactly. Don't believe the hype. So how do we avoid falling prey to these market illusions?
Right. How do we do that?
I think the key is learning to evaluate companies beyond just their financials.
Okay. So let's dive into that a little bit. What are some red flags that we should all be looking out for when we're evaluating a company?
All right. So one that just screams be careful is excessive executive compensation.
Okay.
If the CEO is raking in millions, but the company is struggling, it might mean their priorities are out of whack.
Yeah, that makes sense. It's like, are they in it for themselves or
Exactly.
for the long haul?
And remember those pro forma earnings we were talking about earlier?
Yeah, those sounded a bit like creative accounting to me.
A little bit, yeah.
What are they exactly?
Imagine a company and they're presenting their earnings, but they're doing it in a way that kind of flatters their performance. They might be excluding certain expenses.
Oh, okay.
It's like when you're making a dating profile and you're only highlighting your best features, but you're conveniently leaving out all the,
all the flaws.
Exactly.
Okay. So we've got to dig a little deeper, see what's hiding beneath the surface.
Absolutely. Look for transparency. How are they handling their accounting? Another big red flag is unsustainable debt levels.
Okay.
If a company's borrowing excessively just to stay afloat, it's like building a house on a foundation of sand.
It's not going to, yeah, disaster waiting to happen. So it seems like we need to be part detective, part financial analyst to really uncover a company's true worth.
And part psychologist, because, Graham, he called common investing errors delusions of the market.
Delusions of the market. I like that.
One of those is believing that past performance is going to guarantee future results.
Okay.
Just because a stock has been on a hot streak doesn't mean it's going to continue that way.
Right. It's like assuming a basketball player who's made their last 10 shots is definitely going to make the 11th.
Exactly. Or even the next 10.
Exactly.
Another delusion is thinking that anyone can consistently predict the market. I mean, there are countless gurus out there who claim to have that secret sauce.
Right.
But it's more like trying to predict the weather months in advance. You might be able to get kind of close, but
there's a lot
of chance involved, a lot of luck.
Right. Okay, so instead of chasing these elusive predictions, what should investors focus on?
Building a sound long-term strategy.
Okay.
And that might involve something like mutual funds. They can give you that instant diversification without the headache of picking every single stock.
That sounds good, especially for someone just starting out.
Absolutely.
But how do we choose a good mutual fund?
That's a great question. So first, you have to think about your investment goals. What are you hoping to achieve? Are you looking for steady growth, or are you aiming for those higher returns, even if it comes with more volatility?
Okay.
Next, scrutinize those fees, because high fees, they can really eat into your returns over time.
It's like that saying, death by 1,000 cuts.
Exactly. Those little percentages add up. And finally, look at the fund's track record. Now, past performance isn't a guarantee of future results, but it gives you some insight into how the fund has weathered different market conditions.
Right. It's like checking those online reviews before you try a new restaurant.
Exactly.
You want to see what other people's experiences have been like. Now, you mentioned real estate a little bit earlier. It seems like owning physical property, you can see it, you can touch it,
right,
would feel more secure than, these intangible stocks and bonds.
Yeah, I understand that. There's a certain appeal to owning something tangible, something real, and, it can be a good hedge against inflation. The materials you shared mention REITs, which are real estate investment trusts.
I'll admit, I'm not familiar with those. What are they?
So REITs are basically companies that own and manage income-producing real estate. Think like shopping malls, office buildings.
Okay.
So you're essentially investing in those properties without having to actually be a landlord.
So you get the benefit of the real estate without the headaches.
Exactly. You got it.
Okay. Interesting.
But keep in mind, just like any investment, REITs have their own risks. Market fluctuations, interest rate changes, all of that can affect their value.
Okay.
Now, how about we touch on something that tends to be a little more controversial? Gold.
All right, let's go there.
Some people see it as a safe haven, others as, a relic of the past. What do you think?
Well, it's shiny, that's for sure. But beyond that, I don't know. What do our sources say?
Well, Graham, he was pretty wary of gold. He argued it doesn't actually produce any income, and its value is mostly based on speculation.
Yeah.
However, some investors, they see it as a hedge against inflation or a store of value, when things get a little uncertain economically.
Okay.
It really depends on your own personal investment philosophy and your risk tolerance.
So there's no right or wrong answer necessarily. It's about what
It's personal.
What makes sense for you.
Okay. Moving on, let's talk about bonds a little more. They seem pretty straightforward on the surface, but I feel like there's probably more to it than meets the eye.
Oh, absolutely. You're right. There are definitely nuances to consider.
Like what?
Well, remember, a bond is basically a loan. One risk is interest rate risk. So when interest rates rise, the value of existing bonds, it tends to go down.
Oh, okay. So it's like buying a car right before they announce a big sale, right?
Yeah, exactly.
You're stuck with
You overpaid.
with a lower value asset.
And another risk is what we call credit risk.
That's the possibility that the bond issuer, the one who borrowed the money, they might not actually pay their debt. They might default.
Oh, wow. So it's like you're lending money to a friend, and they might just decide, you know what? I'm not paying you back.
Exactly.
Yeah.
So you have to assess the creditworthiness of that issuer.
Right. Do your due diligence.
Exactly. And then, of course, we've got convertible bonds, which are this kind of a hybrid between bonds and stocks.
Oh, okay. A little bit of both.
Yeah, they can offer that potential for higher returns, but they also come with more risk.
Right. Higher risk, higher reward.
Exactly. They're not for the faint of heart.
So speaking of risk, let's talk about market crashes.
Yeah.
I mean, they're enough to make anyone's stomach churn, right?
Mm.
How can we prepare for those inevitable downturns?
Market crashes, while definitely unsettling, they're a natural part of the economic cycle.
Really?
Yeah. And you know what? They can present some really great opportunities for value investors.
Really?
Remember Mr. Market?
Yes.
During a crash, he is in full-on panic mode, which means he might be offering up some assets at bargain basement prices.
So it's like that Black Friday rush. It might get a little crazy, but there are some good deals to be had if you keep your cool.
Exactly. But you've got to be discerning. Not all stocks are created equal, especially during a downturn.
Right.
Focus on those companies with strong fundamentals, the ones that are built to weather the storm.
So it's about separating kind of the panic noise from the real opportunities.
You got it.
Okay. Now, I know taxes aren't the most exciting topic, but they play a pretty significant role in investing, don't they?
Oh, absolutely. Ignoring the tax implications of your investments, it's like planning a road trip without checking the fuel efficiency of your car.
Okay.
You might reach your destination, but it's going to cost you a lot more than you anticipated.
That's a good analogy.
Right.
Yeah. So what are some key tax considerations that investors should be keeping in mind?
Well, for example, it's important to understand how capital gains are taxed differently from dividends. And then there are the tax advantages of certain retirement accounts, like 401ks and IRAs.
Right. Right. It seems like having even a basic understanding of these tax implications can really impact your overall returns.
Significantly, yes.
Okay. Now, what about those who are feeling, a little overwhelmed by all of this? Is seeking professional help ever a good idea?
Absolutely. Just like you would consult a doctor for medical advice, seeking guidance from a qualified financial advisor can be incredibly helpful, especially during those big life transitions or if you've got a complex financial situation.
So it's not a sign of weakness to say, I need a little help navigating this.
Not at all. It's actually a sign of strength. A good advisor can help you create a personalized plan, give you some objective insights, and potentially even save you from some costly mistakes.
Right. Okay. That makes sense. But how do you even find a good advisor? There seem to be so many out there.
It can feel overwhelming. Look for someone who's got the right credentials, a solid track record, and this is a big one, a fiduciary duty.
What's a fiduciary duty?
It means they're legally obligated to put your interests first.
Oh, okay. That's important.
Yeah.
So it's like choosing a surgeon. You want to make sure they've got the experience and the integrity
Exactly.
to guide you through this process.
You got it.
Okay. Now, let's tackle a common hurdle for new investors, I think, which is that kind of daunting wall of financial jargon.
Yeah, it can feel like learning a new language, right?
Right.
But it's not insurmountable.
Yeah.
The materials you shared have a really helpful glossary of key terms, and there are tons of resources available online and, podcasts like this one that are dedicated to making these concepts easy to understand.
Right, right. It is like learning a new language. It might seem a little intimidating at first, but with practice and the right tools,
You'll be fluent.
you can do it. Okay. Now, with all this knowledge, right, we've talked about a lot today. How do we even begin to make sense of the current market environment?
Well, we are definitely living in a period of economic uncertainty. Inflation is a concern, interest rates are going up, and yeah, market volatility can be pretty unnerving.
It's enough to make even seasoned investors feel a little uneasy.
Yeah, absolutely. However, and this goes back to Graham, he taught us that within this uncertainty lies opportunity.
Oh, okay.
Remember Mr. Market. Mr. Market, he thrives on fear and greed.
So we should be like licking our chops, waiting for him to like make a move. Is that?
Well, I wouldn't say it's quite that simple.
Okay.
We got to stay informed. We got to be prepared. And I think maybe most importantly, keep our emotions in check.
Okay. Easier said than done, though, right?
Oh, for sure.
What are some practical steps we can take to navigate this market turbulence?
Well, I think one thing is don't get caught up in the frenzy. It's easy to make impulsive decisions when things feel uncertain.
So we need to keep a cool head. What else?
Emotional discipline is like your superpower as an investor, especially now. Remember that stat, recovering from a 95% loss? To climb out of that hole, you'd need nerves of steel.
Yeah, and a near impossible 900% gain.
Exactly. That's why panic selling rarely works out well for people.
It's like hitting the eject button right when the plane starts to shake a little bit.
Exactly. You got to ride it out.
Okay. So how do we actually cultivate that calmness when everything feels so chaotic?
It all comes back to having that solid investment plan. When you know your goals, your risk tolerance, your time horizon, it's like an anchor in that stormy sea, right?
Okay, yeah.
You can weather those waves instead of letting them knock you off course.
So it's about sticking to the plan,
Yeah.
even when every instinct is telling you to get out.
Yes. Don't listen to your gut in those moments. Listen to your plan. And remember, a stock, it's not just a blip on a screen. It's a piece of a real business, right?
Okay.
So instead of freaking out over every little price swing, ask yourself, has the underlying business actually changed?
So we got to see through all the noise and focus on the fundamentals.
Exactly. I mean, if a company that you own has solid financials, a strong competitive position, and its long-term prospects still look good, a market dip, that might not be a disaster.
It could be an opportunity.
Exactly. A chance to buy more at a discount. It's like what Warren Buffett always says, be fearful when others are greedy and greedy when others are fearful.
Yeah, that's a good one.
Yeah.
But that takes guts, doesn't it? Going against the grain like that.
It does. Value investing is as much about mastering your emotions as it is about the numbers.
That's interesting. I like that.
Yeah. And speaking of emotions, greed, that can be just as dangerous as fear.
Oh, yeah.
Right.
For sure. I mean, we've all heard those stories of people who got caught up in those speculative bubbles, chasing the next big thing, and then they get burned.
It's that allure of those quick riches.
Easy money.
Yeah. But Graham, he warns us about that. That's not investing, that's gambling. True investing, it's about building wealth steadily, brick by brick.
It's a marathon, not a sprint.
Exactly. But it's tough. We live in a world that's completely obsessed with instant gratification.
It's true.
So how do we resist that? How do we resist that siren call of, easy money?
Yeah. How do we do that? It's so tempting.
I think it always goes back to having a sound investment philosophy.
Okay.
A set of guiding principles that you stick to no matter what, no matter how tempting that latest, market fad might seem.
So it's like having those, like a moral compass for your money.
Yes, exactly. A moral compass. It's guiding you towards those sound decisions, even when you're tempted to stray.
I like that.
Okay.
Okay. So what are some of those guiding principles? Give us the short list.
Well, one of the most important ones in value investing, it's Graham's concept of margin of safety.
Yeah, we touched on that earlier.
Right.
But I think it's worth repeating. Just remind us what that means again.
So you're buying assets for less than they're actually worth.
Okay.
Think of it as a buffer, like a margin for error, right? Just in case your calculations are a little off. If you can buy $1 for 50 cents, you've built in a safety net.
That makes a lot of sense. It's so simple, but it's easy to forget. Buy with a margin of safety.
Okay, that's a good one. Any other sort of fundamental principles that we should be keeping in mind as we go on this journey, as we become investors?
One more. And it's probably the hardest one to really master, and that's patience.
Okay.
Value investing, it's a long game. It's
Okay.
about planting those seeds, nurturing them, and waiting for them to grow.
No get-rich-quick schemes here.
No, no, no. This is the slow and steady.
I like it.
Embrace that long-term perspective. Ride out the market's fluctuations because they're going to happen. And remember, maybe the most valuable investment you can make is in your own education.
Keep learning.
Always. Okay, so as we kind of wrap up this deep dive on, value investing, what are some key takeaways that our listeners should remember as they move forward?
First of all, remember Mr. Market. He's going to be there, always lurking. Don't let his little emotional roller coaster dictate your investment decisions.
Right.
Second, focus on the fundamentals. Analyze the actual businesses, not just the stock ticker symbols.
Right.
And then finally, embrace those principles we talked about. Margin of safety, patience, continuous learning.
It's been really great exploring these ideas. It seems like, successful investing, it's not just about picking the right stocks, it's really about cultivating the right mindset.
Completely agree.
So for anyone listening, as you embark on your own investing journey, remember to think like an owner, be patient, and never stop learning.
It can be tough though, right? To drown out that noise.
Yeah. I mean, especially when you're seeing those headlines,
Yeah.
everyone's freaking out. It's easy to get caught up in that.
Absolutely. That's why, going back to having that plan,
That's
that's so important.
Having that plan and sticking to it,
Exactly. Because if you've done your homework
right?
and you believe in the businesses that you own, a downturn, it's not the end of the world.
In fact, it could be a good thing, right?
It could be. You could look at it like a sale.
Right. Like everything's on sale.
Exactly. And you get to, buy those things that you wanted at a discount. It's like, what was that quote by Buffett? He said, be greedy when others are fearful.
Yes.
And fearful when others are greedy.
Right. But that takes a lot of courage to go against what everyone else is doing.
It does. You have to be like a contrarian. But that's what value investing is all about. It's about having the conviction to stick to your guns when everyone else is running for the hills.
Right. Right. Because if it were easy, everyone would do it. Right.
Exactly. If it were easy, we'd all be millionaires.
Exactly. Well, thank you so much for taking the time to kind of walk us through all of this. I think there's some really, really valuable lessons here for everyone, no matter where they are in their investing journey.
My pleasure.
So for anyone listening, if you're feeling inspired, I encourage you to pick up a copy of The Intelligent Investor. Check out some of these other resources that we've talked about and really start thinking about how to apply these principles to your own life and your own financial goals. Remember, investing doesn't have to be a mystery. With a little bit of knowledge and a lot of patience, you can achieve those financial dreams.